In Chapter 21, we'll take a look at the accounting for leases. In this chapter, the book covers both the accounting for leases from the party taking the lease and from the party giving the lease. We're going to skip the accounting from the lessor side, so from the side of the party giving the lease. We'll just cover it from the lessee side, so from the standpoint of the party getting the lease. All right, so a lease is just a contract between a lessee and a lessor. Again, as I was saying earlier, the lessor is just the party giving the lease, and the lessee is the party getting the lease. So let's just say you go to a car dealership to lease a car. In this case, the dealership would be the lessor, and if you were the one to lease the car, you would be the lessee. So if you think about what a lease is just the right to use the property. So the lessor will give us the right to use the property, and in return, from the lessee's standpoint, we're just giving cash over to the lessor. If we take a step back and compare this to purchasing an asset by financing it, the transaction ends up looking really similar. All right, so the seller is going to end up giving property to the buyer, and in return, the buyer just gives cash over to the seller. All right, so again, this looks very similar to a lease. And technically, in this purchasing transaction, while there could be a third party involved, so the financer, it doesn't change the substance of what's going on. So in many ways, if we look at this, a lease is very similar to purchasing an asset. Right, and so because a lease looks very similar to purchasing an asset, this has sparked debates about whether a leased asset is essentially just an asset. Depending on whether for accounting purposes we recognize something as an asset, it will affect how we end up accounting for it. Now, many people have argued that technically under a lease, ownership of the asset is not transferred over to the lessee. So if the party doesn't have legal title, technically it's not an asset. But on the other hand, the party or the lessee does have the right to use an asset. If we look at the definition of an asset, so an asset defined within our accounting framework, assets are probable future benefits obtained or controlled by an entity. So this issue of how to account for leases comes down to this classic case of substance versus form. Form just refers to making decisions based on the rules. And then substance is just the other way. Instead of making decisions based on rules, we're going to use more logic or common sense. So in this case, if we based our decision on form, you would say leases are not assets because legal right has been transferred. If we base our decision based on substance, we would say leases are assets because the lease pretty much gives us the same rights as the rights of ownership. So generally, in more recent years, the FASB's taken the stance that we should account for something based on its substance and not on its form. So in 2016, the FASB adopted the third approach here on the slide of how to account for leases, and that is we will capitalize all long-term leases, so any lease over a year. Just a quick refresher, capitalize just means essentially put it on the balance sheet. So we will recognize an asset. Right, the opposite of capitalizing is expensing, which I'm sure you already know. It just means you expense the item right away. So we're going to capitalize all long-term leases. Now, when a company has a lease, it's going to end up classifying the lease as either financing or operating. Regardless of the classification, we're going to still recognize a lease asset and liability on the balance sheet, so the classification won't affect that. However, the classification will affect how we account for the leases on the income statement. We'll take a look at the accounting for financing and operating leases after we cover the classification process. So as we said earlier, the difference between a lease and buying an asset comes down to control over an asset. In the same way, we classify a lease based on certain criteria that determine if control has essentially passed from the lessor over to the lessee. If a lease essentially transfers control or ownership of the asset to the lessee, then the lease is classified as a finance lease, right? So kind of like if we just financed the asset and purchased it. On the other hand, if the lessor still controls or owns the asset, then the lease is classified as operating. So in other words, operating is more like the lessor is just renting or loaning the asset over to the lessee. And so the next question becomes, how do we determine whether the lessee has control or ownership of the asset? When we start getting into details of this, ownership and control is not necessarily black or white. It's really more of a continuum. So for example, if you lease a car, you have the right to drive it. However, if the lease contract states you can't drive the car more than, say for example, 1,000 miles a month, you only have some control over the car. And so in this case, it's kind of like you own it, but you also don't really own it. So to determine whether a lessee has enough control over a lease item to account for it like an asset, we use lease classification tests. So the lease classification tests is summarized on this slide here. For a lease to be classified as finance, it cannot be canceled and it needs to meet at least one of 5 of these tests. If it meets any one of 5 of these tests, it's classified as financing. If not, then we're going to classify it as operating. We'll go over each one of these tests on the upcoming slides. All right, so the first test is the transfer of ownership test. All right, so this test is very straightforward. Pretty much in the lease agreement, if the asset at the end of the lease term gets transferred over to the lessee, then clearly it's a finance lease. So the transfer ownership just asks, does ownership transfer to lessee at the end of the lease? Right, and if it does, then it'll be a finance lease. Second test is called a bargain purchase option. All right, so sometimes a lease allows the lessee to purchase the asset at the end of the lease term. If the lessee has the option to purchase the asset for a price that's significantly less than its expected fair value, then we'll end up classifying the lease as financing. So the basic idea here is if at the end of the lease term, the lessor is going to gives the lessee the option of buying the asset at such a low price, it's pretty much guaranteed they're going to take advantage of that. And so then we essentially have a financing lease. So the bargain purchase option just says essentially, can the lessee buy the asset for cheap at the end of the lease? The next test is called the lease term test. This test essentially suggests that if the lease term takes up most of the asset's remaining economic life, then essentially we have a sale, and so it should be a financing lease. Right, we'll use 75% of the economic life as the cutoff point to determine whether it's most of the asset's useful life or not. So in regards to the lease term is generally going to be the fixed portion of the lease that can't be canceled. However, sometimes in a lease there's called a bargain renewal option. Bargain renewal option just means that the lessee can extend the lease for a longer period of time at a really cheap price. All right, so if the lease has a bargain renewal option, chances are that the lessee is going to take advantage of it. And so then we would add that on to the lease term. So lease term test, just asks, is the lease term greater than or equal to 75% of the remaining life? The next test we'll cover is the present value test. So this test just suggests that if our lease payments essentially end up covering the purchase price of the asset, then effectively it's the same as us purchasing the asset. So in other words, if we take the present value of our lease payments, and the present value is greater than or equal to 90% of the fair value of the asset, then we've bought the asset essentially. So to determine the present value of the lease payments, we need to know the lease payments and the appropriate interest rate. In determining the lease payments, we're going to include any fixed payments. So for example, if we have to pay $10,000 a month for a lease payment, that amount will obviously be included. Sometimes with a lease, you have variable payments. All right, we'll add the variable lease payments and the variable payments in the lease payments only if we know the rate in advance. So for example, let's just say in addition to a $10,000 per month lease payment, our lease and payment will increase by $100 a month. So in this case, we know in advance what our future lease payments will be. So we'll include the increasing $100 payments in the lease payments. However, let's say in addition to a $10,000 per month lease payment, we also have a variable component that depends on future sales. So let's just say they also want to take 3% of future sales. In this case, we don't know what our future lease payments are going to be like because we can't perfectly predict the future. So in this case, only the $10,000 lease payment will be included and that variable portion will be expensed in the period it's incurred. The third possible component of the lease payment is called a guaranteed residual value. Guaranteed residual value just means at the end of the lease term, the lessee is going to guarantee that the residual value of the asset will be a certain amount. So if it ends up hitting the end of the lease term and the residual value is lower, then the lessee will pay the lessor some kind of cash to make up for the difference. And then the last possible component of the lease payment is the cost of a purchase or termination option. So if the lessee has the option to purchase the asset at the end of the lease term, and it's likely they're going to take advantage of the option, then the cost of the purchase price should be included in the lease payments. Second part, if the lessee has the option to terminate a lease before the lease is up, and it's likely they're going to use that option, then we'll include the cost of the termination fee and the lease payments as well. So after we've determined what the lease payments are for the present value test, we need then to figure out what interest rate we use. So the lessee is going to use one of two interest rates. If possible, the lessee should use the implicit interest rate on the lease. So in other words, when the lessor goes to set the lease payment terms, they select payment amounts that will allow them to earn a certain rate of return. This is called the implicit interest rate. It's the lessor's required rate of return. So the lessee will try to back into this rate by using the formula here. right under the implicit interest rate. I'm not going to require you to have to calculate the implicit interest rate in this class, so this part is just a little bit of extra information for you. But generally, in the real world, the lessee is not going to know the unguaranteed residual value of the asset or the lessor's deferred initial direct costs. So generally, they're going to end up using the IBR, or the incremental borrowing rate. The IBR is just the rate of interest the lessor would have to pay if they took out a collateralized loan and the amount of the lease payments. So in other words, you could just think of the IBR as their borrowing costs. So for any exam questions, again, I'm not going to have you calculate any interest rates. You should know what each interest rate refers to, but pretty much this boils down to use the implicit interest rate if it's known. And if we don't know that, then use the incremental borrowing rate. And so the very final test, or the last of the 5 tests, is called the alternative use or specialized asset test. Right, this test pretty much says that if the lessor doesn't have a use for the asset at the end of the lease term, then the lessee is going to classify the lease as a financing lease. So in other words, if there's no other use for the asset, it's pretty much the same thing as if the lessee purchased the asset. All right, so these are your 5 tests here. Now that we've gone over the lease classification tests, let's apply them to a couple of examples. So we'll start with brief exercise 21.1. And this is asking us how to classify the lease. All right, so we'll start with the transfer of ownership test. So we're just looking for information that tells us if transfer or ownership transfers to the lessee at the end of the lease term. All right, so we could read through this. Lease terms 5 years, equal annual rental payments of 31, has a fair value of 150, estimated useful life of 8 years, guaranteed residual value of 15.5. Rate of return is 6%. It's known to Callaway. Gives us some present value terms here. And then in this final bullet point, it tells us the lease does not transfer title or contain a bargain purchase option, is not a specialized asset. So it tells us for transfer of ownership, right? The lease does not transfer title, so that's a no. Also tells us it does not contain a bargain purchase option, so it does not pass this test. And then also tells us it's not a specialized asset. So answer to this will also be no. Again, remember for the lease classification test, the lease only has to pass one of these tests to be classified as financing. So generally when you go through these, start with the easiest tests first and then go to the hardest one last. So generally, or the present value test is going to take the most time to test, so we're just going to go to the lease term test next. All right, so again, the lease term test, it says, is the lease term greater than or equal to 75% of the remaining economic life? All right, so we need to figure out the lease term. Lease term is 5 years. And the remaining economic life is given in the second bullet point. The equipment has a fair value at the commencement of the lease of 150, estimated useful life of 8 years. All right, if we took 5 divided by 8, you'd get out to 62.5%. And so obviously this is not greater than 75% of the remaining life. So the answer to the lease term test is no. So that means the last test we have to run is the present value test. Okay, so for the present value test, first we need to figure out what the lease payments are, or what's included in the lease payments, and then we need to take that present value. So in this case, again, we're going to include the present value of the fixed payments. So in the first bullet point, it tells us we have equal rental payments of $31,000 at the beginning of each year. So hopefully you remember how to calculate your time value concepts. If these are equal rental payments at the beginning of each year, we have an annuity due. Right, and then to calculate the present value of an annuity due, we need the number of compounding periods. So in this case, it's 5 periods, because the lease term is 5 years. And then our interest rate, we said we would use the implicit interest rate if it's known. So in this third bullet point, it tells us Photon set the annual rental to earn a rate of return of 6%, and this fact is known to Callaway. So Callaway, the lessee, knows this 6% rate of return, so that's what we use. Right, and so as we learned in the past, the present value of an annuity due is equal to the rental payments times the present value factor for an annuity due. The present value factor is given to you right here for an annuity due for 5 periods at 6% of 4.46511. So the present value of these rental payments will be equal to the rental payments here of $31,000, and we'll just multiply that by the 4.46511. Right, and that'll get us out to 138,418. Now, in the rental payments, we'll include any variable payments if we know how they'll affect our future lease payments. In this case, there's no indication of variable payments, so we can skip that. We'll include the guaranteed residual value, if any. Here we have a guaranteed residual value at the end of the lease of $15,500. So in this case, this guaranteed residual value is just a single amount that needs to be guaranteed at the end of the lease term. So in this case, we would calculate the present value of a single sum to figure out the present value of the guaranteed residual value. So present value of a single sum is equal to the future value times the present value factor for a single sum. Again, the number of compounding periods is 5, and the interest rate is 6%. If we looked up the present value factor, it's given on the slide at 0.74726. So the present value of a single sum will be equal to the guaranteed residual value in 5 years times this present value factor. If we multiply that out, we get out to 11,582 and 50 cents. So if we add these up, we get out to $150,000 roughly. So we just want to compare this present value here to the 90% of the fair value of the asset. So the fair value of the asset is $150,000. So 150,000 times 90% is 135. Well, actually, we don't even have to run the test since the present value of the lease payments is greater than the fair value, or it's equal to the fair value. So this lease does pass the present value test. So that means we will classify this as a financing lease. Okay, so let's go into the next example. So I'm going to get rid of this. So we can start from fresh again. So in this example, Jelly is leasing or is the one leasing the equipment. So Jelly's the lessee, Squishy's the lessor. Again, we're trying to figure out how to classify the lease. We'll start with the transfer of ownership test. Again, generally do the present value test last because it'll take the longest. So do the test in the order listed on this, listed over here on Excel, because this will get you through the problem quickest. All right, so the transfer of ownership test, we'll just look for information telling us does ownership of the asset transfer to the lessee at the end of the lease term. All right, so if we look at our information here, the bottom bullet point again tells us lease does not transfer title, it does not contain a bargain purchase option, and the equipment is not of a specialized nature. So that tells us transfer of ownership test, it doesn't pass. Bargain purchase option, there's not one, so it doesn't pass that test. And it's not a specialized asset, so it doesn't pass that test. So we'll go to the lease term next. Lease term test next. Is the lease term greater than 75% of the remaining life? So we need to figure out what the lease term is. In this case, it tells us it is 5 years. Okay, so we'll put 5 for the lease term, and then we need to figure out the useful life, or remaining useful life. And so there's a renewal option to allow Jelly to keep the equipment 1 extra year for a payment at the end of the 5th year of $10,000, which Jelly is reasonably certain and will exercise. So here, remember for the lease term, if there's a bargain renewal option, then we're going to include that in the lease term. Since Jelly is reasonably exercised, it's going to include this. We're going to increase the lease term up to 6 years. All right, so it tells us the equipment has a fair value at the commencement of the lease of $76,024 and estimated useful life of 7 years. So useful life will be 7. And if we take 6 divided by 7, we end up with 85% of the the asset's useful life. So the the lease term is over 75% of the useful life of the asset. So this asset passes the lease term test, which tells us that we can classify this as a finance lease. Right? We don't have to do the present value test because, again, if a lease passes any one of these tests, it'll be classified as finance.